Good Friday morning, Market Chameleons, and everyone joining us for the first time. Thanks for coming by and checking out the Market Chameleon pre-market show with this man who looks like me at the moment, coming in all the way from the city of brotherly love, Dimitri Pargamonic. How you doing, D?
Hey, Will, I think you're on mute.
Oh, really? I can hear you. Let me ask. I'm definitely not on mute.
Well, yeah, I think you're on mute.
Yeah. Well, you want to read the disclaimer? Hello. Can everyone hear me?
Hey, well, can you unmute yourself?
I'm not muted.
But, well,
Pick up your phone.
okay, I could hear you now.
Yeah, everyone can hear me. I wasn't muted.
Oh,
Uh,
okay, maybe that was
yeah,
okay.
not a problem. Uh,
Um,
so we want to read the disclaimer?
yeah, good morning, everyone. Before we get started, keep in mind Will and I and Market Chameleon, we're not a registered investment advisor. We're not a broker dealer. We're not telling you what to do. We're just sharing ideas. If you need advice, call your registered investment advisor, call your broker. That's what they're there for. There's the disclaimer.
Perfect.
And I'm going to share my screen. Well, can you?
Yep, you're up.
All right. And as I'm doing it, if anyone's joining us for the first time today, Will and I, we do these shows in the morning to try to help answer questions you may have about the Market Chameleon tools, the data, or the analytics. If you have a question, type it into that live chat on YouTube. Will's watching it. He'll read it back to me. And to take a couple minutes and give you guys a chance to put those questions in, we'll start out looking at the pre-market report, see if we could get insights, what's trading in a pre-market hours, and then we'll move on to the questions. So pre-market report, these are stocks trading in the pre-market hours. We have a calendar view up top that allows you to go back if you wish to a historical date and see what happened in the pre-market hours. Historically, today we're on January 19th, and so far, this is what we have from a high level. There are 474 stocks trading higher in the pre-market, 247 stocks trading lower. As far as volume goes, we have 119 million shares trading on up volume, 191 million shares trading on down volume. If we convert that volume to dollar value, we have $3.5 billion worth of stock trading higher, $845 million worth of stock trading lower. From that perspective, looks like the trading in the pre-market hours so far is with a bullish lean. Let's take a look at it from a couple more perspectives, then we'll move on to the questions. And down here, as I scroll down the page, we have a list of symbols that are trading in the pre-market hours. We see the price change, volume, and so forth. So these are our most active stocks, our biggest percentage gainers in the pre-market hours, our biggest percentage decliners. Here we see 98 stocks made our biggest percentage gainers list, 52 on our largest decliners list. So from that perspective, that also indicates that traders in the pre-market hours are trading with a bullish sentiment, bullish lean. If we look at this list, well, first of all, to make this list, we do set certain thresholds for liquidity, price change, volume, and so forth, because things in the pre-market hours tend to be very illiquid or trade very low volume. But to make this list, it could be any security listed on the major U.S. exchanges as long as it meets our threshold. So you could see a ETF in there, a leverage products, an inverse product, the closed-end fund preferred, low cap stock. To narrow down this list to a smaller group of stocks, we could use the filters here above. If you have a watch list, you can filter by your watch list. Just drop it down, select your watch list. We're going to use this filter in ETF in our example. I'm going to click on that, get a drop down menu to select from, different ETF symbols. We're going to choose this one, SPY. And when we do that, the list below gets filtered by the holdings or stocks that are holdings in SPY, which are the S&P 500 constituents. And here we have 20 stocks that made our percentage gainers list, 1 on our decliners. And that also indicates that traders in the pre-market hours are trading with a bullish outlook, bullish sentiment. So we gave it a couple minutes. Well, if we have a question, I'll take it now. If we don't, I'll kind of continue on our conversations from previous days.
Yeah, nothing's popped up yet, D.
Okay. Let's come to SPY. And usually that's my default symbol to demonstrate some of the tools. And when we were looking at it from the last couple of days, we were looking at the options chain. And from the options chain, so this is the SPY options chain, I'm going to just come out to an expiration that is not expiring in the next day or so. So this is the January 26th expiration. We have 6 trading days to go, 8 calendar days. And what we discussed was setting up either a single option or an option strategy, and then trying to compare the market prices to a certain benchmark, right? A historical benchmark or evaluation model. And let's see here. I'll just come out and pick a option. So here we have a call for 480 strike. I'm going to click on that call. And now we have this ticket by January 26, 480 call for $1.75. When I hit calculate, we ran an option profit calculator. So we could see what the payout is at expiration at different stock levels. And then we talked about this distribution Theo value. And with the distribution Theo value, just a quick recap, is it looks at the historical stock prices, the historical stock behavior of SPY. And it says, if we see what the market price is of this option. And what we're curious about is, well, what do we think in theory this option is worth, or what would be a good benchmark to compare the market price to a theoretical value, right? So the market prices are there where we could observe them, anybody could see them. So those are simple, but how would we appraise this option? What kind of value would we potentially give it? So we start out with some baseline benchmarks, and the historical return distributions, that's one method. There's no single method or single right way to do it, but we got to start somewhere with the baseline. Then the historical return distribution says, okay, let me look at SPY historically, see how it moved in the past, and based on many observations, right? So I'm going to go back years of observations and find similar situations. So I got to find data with a similar situation or conditions that I'm trying to evaluate. So in other words, I need to look at time periods of 6 trading days, an option that's this far away. I might narrow it down to where the implied volatilities in general are high or low. And using that, based on how the stock moved, what is the average end value of this option, right? So that's what this is. So you could see here, it looked at 84 historical observations. Could open them up here and sees how the stock moved historically, came up with theoretical values for each observation, right? And then said, what is the average value? And that's, now we have some kind of historical benchmark, a baseline valuation to start out with, right? So this one is $2.53. So this looks like, well, these calls are not super pumped based on that benchmark, right? If anything, they look like they're at a discount. So this method here looks at only historical stock returns, right? That's what this is doing. It's looking at historical stock returns and trying to put a theoretical value to this option to compare it to. So let's look at a different method. What if we looked at it from another perspective and said, okay, what if I don't have the historical stock returns, or I already looked at that, but I want to know historically, based on the implied volatility levels of a similar option, right? So now we took out the stock completely out of this equation. And we said, let's just look at the implied volatility levels, right? So where do the implied volatility levels come? They come from the option prices, right? So now we're analyzing historical option prices and implied vol. And if we said, okay, based on historical implied volatility levels of an option that's similar to this one, because remember, this is what I'm picking. So I'm looking at an option with 6 trading days to go, 0.75% above the spot price. And where does that option, right? That option historically, where's that implied volatility, right? And based on that implied volatility, what would the value of this option be? So if historically the implied volatility was exactly this, whatever this is, like say 10, right? Because currently this is like, let's say 10. Well, if historically the implied volatility was always 10, then this option would be, fair value. That's what it always is, $1.75. But it fluctuates, right? Trading and markets, they fluctuate. They move around. Implied volatilities move around. So it's not always at exactly 10, but it doesn't fluctuate where, goes to a gazillion, zero, it fluctuates within some range, right? So some historical range, maybe 20, 5 and 20. We don't know. We're going to check right now, but it's not going to, go to 1,000 one day, to 0 the next day, to 10,000 the next. It doesn't do that. So we need to figure out, well, where is it within its historical range? All right. That's what we're going to be looking at. So this is a different method. Now we're going to do evaluation. So I'm going to go here to the IBKR. And this IBKR, right, what it's going to do is say, okay, here the machine already started picking up the conditions and circumstances for us, so we don't have to set that up ourselves. And it says, okay, here's this option expiring January 26th, 6 trading days left, 0.7% from the spot price. There, this is the SPY doesn't have an earnings date. It's an ETF. Find me similar options. Okay, similar, and it's going to calculate, benchmark for us. And what was the historical implied volatility? So it goes back daily, right? Creates an index and says, okay, these are the implied volatilities of a similar option, right? So 10, 10.4, 9.7. You can see it fluctuates around, right? And it goes back in time. And then it says, okay, if I gave this implied volatility to the option today, right? If I gave that implied volatility, assigned it to today's option, what would that option be? Well, if, 10 would be $1.77, 10.4 would be $1.88, 9.7, $1.70. So you could see here that in theory, this is what the option would be worth today if we use these IVs. And then it goes back and says, okay, let's get some summary stats on that. All right, there's 503 observations here. Let's get some summary stats. So we see what the average is, $2.28. Right now we're at $1.75. So from an IV perspective, option premium, this also indicates that currently we're below our average baseline. Okay. So it doesn't look super pumped. If anything, it looks like it's at a discount. If you think IVs and historical vol will revert to its mean, it looks like it's at a discount. Well, what else do we see here? Well, what are the range? What is the range and how close are we to the high, low range, or are we like right in the middle there? So the high, $4.49. Okay, so let's see that. So here, 4.49. So January 26, 2023 of last year, right? So this is going back a year. The IV was up, right? 19.6. So this is our high in our observations. So if we took the high range, the highest range, I think we're going back 4 years of data here. So in the last 4 years of data, we could change we could narrow this data down, but it's defaulted to 4. But in the last 4 years, if we took the high range of our observations, then this option, today would be $4.49 if we use that high IV. What about the low range? So I'm going to sort it here. And here, in 2021, August 13, 2021, looked like the implied vols really plummeted. This similar option, we captured 6.7 vol. So that's a big difference, right, between 19 and 6.7. So it's a wide range. But if we gave it a 6.7 implied volatility today to the same option, if we gave it a 6.7 volatility, right, we're talking about 89 cents. So this option would plummet to 89 cents. Now, it is it's a wide range, and I don't know if it's going to go up or down. We don't know that, but now we have certain benchmark baseline to start making more informed decisions. We see that, okay, we are, closer to the lower range than the higher range, right? Less than $1 away from the low. We got, over $2, whatever, almost, closer to $3 away from the high, and we're below the average. So here now the takeaway is, all right, that this option is not super pumped. It's not on the high range of the IV. If the IV goes up, there's a lot of, from our historical range, there's still a lot of room, and we're below that average, right? So that's the takeaway from that analysis. Now we could move our data around, and let's say we just want to know for the last year, Maybe in the last 4 years, there are lots of funky things going on. Let's just look at the last year. And I'm going to put it to 1 years of data. I'm going to recalc. And now we have different stats. So now the range is more narrower. We did use less data. And based on the last year's of option prices, okay, that's all. We're only looking at option prices, not how the stock behaved. And now we see that on average, this in theory option is $2.03. If we looked at all the data points, the high value $2.74, low value $1.39. So again, this appears to be right now trading, I would say, on the lower end or on the more cheaper side of the IV than in a historical perspective. So those are two different methods, right? We looked at two different methods, got two different theoretical values. And we could change those parameters around, number of years, IV.
Hey, D,
Yeah.
as you're talking about the parameters, Lauren did ask a question for Dimitri. He's saying he thinks that he says, I don't think the average gives enough info. Why not add median and mode? I'm not exactly sure what that means. And he's talking about the IV tab. I don't know if you want to.
Yeah, no, that's good. So, and I probably will add the medium, and that's a good point. So what is the median mode? And I'm glad he brought that up, because a lot of some of our users, an average high low is what they'd understand, right? And once you get into like median and mode, and we do show median mode in lots of places, and I probably will add it, but what is the median and mode, first of all? So the average, right, when we say like 203, right, well, that could get pulled up because we have a couple big observations. So here, it's not like one big outlier here. So we do have, on this high end near 274, we got 267, 265, and so forth. But that could pull up the average. Let's say we had one observation here that was like 5, or the IV, right? This is the price, but the IV was, one day maybe it spiked to 20 and then went back down to 13. So that one day would have pulled up the entire average. And so one way to look at that skew, if the average is skewed to one way or the other, is comparing it to the median price. And the median price is separating all these values, right? So we have all these values here. There are 125 of them. What if we separated them by 50%, the highest, 50% the lowest, right? So we took them and split them in half. Like, here's the highest 50% of the observations, and here's the lowest 50%. And then we took what is the implied volatility right in the middle? Right, that's the median, 50th percentile. So let's say the median, I don't know what it is here, I should add it, but let's say the median was, turned out to be that this was $1.75, whatever the implied was. That means that, that we're in the 50th percentile. That's, when you guys do IV percentile rank or something, you could use the median for it. So that would tell us, if it was $1.75, that, okay, well, half the observations were, above this, half were below, or right in the middle, but the average is skewed a little bit towards the upside, right? Because we had some outliers potentially that skewed up the average. So that would be the median. But what about the mode? If we add those in our summary or descriptive stats. So what about the mode? Well, the mode is looking at the observations here, right? And you can see they're all different, but some repeat 13, 13, 13, right? So the mode would look at all the data and say, what implied volatility appears the most, right? Like which one appears the most? Is it like 13? Is it 12.8, 13.1? So that would be the mode to say what is the most recurring one out of our data observations. So those are two good, I agree. Those are two good stats. It gives you more information for sure, gives you deeper insights. So those were, and let me think, why we may have, because you guys can do strategies in this. So, right now I have, when it's a simple call, it's a little bit different. Let me just see how it would look like. What if I clicked on one and sold one here? So this would be like a risk reversal, right? I'm buying one option, selling another one. So this is a multi-leg strategy. So over here, when you do a multi-leg strategy, how do you get a valuation for that? Well, you'd have to take a snapshot at exactly the same time. So now I have two legs here. All right. I have one, they're both the same expiration, so they both have the same days to go, but one, is 0.7% away, one is negative 0.8% away from the spot. So the distance from the spot and each other is different, and one I set up as a buy and one is a sell, right? So now there's a couple differences here. And what is this machine doing? What is this software doing? Well, it's going back and saying, okay, now I need these two similar options, right, where the implied vol was at the same time, because now we need the relationship. Not only do we need what the option is like on January 18th, but we need a snapshot at exactly the same time, so we know what is the relationship between those two options. In other words, implied volatilities could move around, as we saw from 6 to 19, but the relationship between options can move around, but they also have some kind of like band or range, so you're not going to see, one go to 0 and one to 1,000,000, right? And then go revert. They have some kind of a relationship where, that if they get too far away or whatever. So this is what this is doing. It's saying, I need a observation of these two options, simultaneously, because that's what I'm trying to evaluate, the difference or the differential between these two options. So we could see here yesterday, the difference was 1 click. Before that it was one, this was 1.3, this was 1.2 clicks, involved. This was 1 click. So it's going through that and saying, okay, based on those observations, and by the way, this could be dynamic too. Maybe as implied volatility goes up, I don't know, they spread out. As it goes down, they come back in. I don't know, but this is what it's doing. It's capturing those relationships between the two different options, right? And then what it's doing is saying, okay, well, based on the strategy I selected, right? I'm not buying both. I'm buying one, selling the other. So if you're, so it's calculating the theoretical value on this, using this IV, theoretical value using this IV, and saying the difference is this, right? In today's terms. Now it's using, you know, historical IVs converted in today's terms, if it was right now, and it's calculating the theoretical difference between the two. And now it's creating this average, right? High, low. So I guess I could probably put a median in there as well for this. And so I guess that would work, you know, as I'm looking at it. And
that's super helpful, Pete. Laurent is very appreciative of anything you can do for that. That's great.
Yep. Yeah, thank you. I appreciate that question.
Well, we're into the opening bell right now by a couple minutes. Awesome job.
All right. And everyone, thank you for joining. Stay safe out there. Have a great weekend. Have a great trading day, and we